in South Africa, and we just had the GDP numbers come out about just under an hour ago, in fact, and I thought they surprised to the upside. In the studio in Cape Town with me is independent economist, and that's Cobus Venter. Cobus, you've had a chance to look at these numbers. I mean, I personally thought that they would be worse than expectations. They've come in slightly better.
Yeah, if you look at the underlying factors that led to that, it's really a massive jump in mining, which jumped 31% year on year, which effectively is not it's not a trend reversal. This does not lead to a sustainable output growth in mining specifically. I think you certainly can't maintain those kind of growth rates.
This is a base effect as well, isn't it?
It's a base effect after the first quarter's releases. I think if you digest it a little bit further, you'll see that there are still several underlying trends which are concerning, specifically electricity production, which actually declined by just over 4%, which implies that the domestic economy is still weak. Retail sales, 2.8%, or wholesale retail trade sales, also fairly weak. So in general, not a great picture emerging, and the headline number hides the fact that it's really only the mining readjustment that took place after the first quarter's very bad results. And considering what is happening in the mining industry and the potential for further industrial action, one doesn't necessarily see this positive trend continuing.
You haven't had a chance to crunch the numbers enough, but if you took out the 31.2% and got it back to what you might reasonably expect it to be, something like, I don't know what it might be, between 5 and 10%, what would this number have looked like?
Probably close to 2.5%, which is maybe even a little under the consensus view of things.
So we can more or less say with a good deal of confidence that this was a once-off, yes, because of the base effect, because of the massive jump of 31.2% in mining, and we will revert to the mean in the next quarter.
I think so. Unfortunately, I mean, I'd love to be able to sit here and tell you much better stories, but I think the reality is that the rest of the year is still going to be weak. Significantly, there's further weakness in commodity prices going forward, and unless some of those are mitigated by a weaker currency, the second half is not going to be significantly better. So we're still looking at a 2.5, 2.6% GDP for the year.
Manufacturing at minus 1% is always disturbing because it's still 16.5, 17% of GDP in South Africa. The PMI has jumped above 50 recently, so maybe that will stabilise as well. But as you say, some of these numbers are really quite pedestrian, aren't they? I mean, construction at 4.3%. I'm surprised it's even up there given the state of certain areas of the construction economy. Retail sales at 2.8%, worldwide growth slowing down. What's your target for the year end GDP?
2.6.
2.6.
Yeah, unfortunately, and I think the construction number to me is actually quite a positive one, because it does imply that there is life in that sector, which for the last couple of years has been under tremendous pressure. And you see, when you start analysing within the sector, there's a lot of the bottlenecks that are opening up now. So I think a bit of a counter-cyclical movement from construction coming again, which is a positive sign. But if you look at manufacturing and you combine that with electricity, which is down quite significantly, it does imply that specifically from the retail side, more and more of that's being taken up by imports, which is not good for manufacturing going forward either.
No, and give us the significance in your eyes of the electricity fall. Is it just simply because industry isn't using as much electricity?
It varies. It's often adjusted as well, but that is the bottom line. If you're not producing the electricity, it's not being used either.
This is one figure that I know when the Chinese GDP comes out, people focus on immediately.
It's probably the most reliable indicator.
Yeah, they look beyond the headline numbers. Is the same true for South Africa?
No. I think the quality of our data is significantly better than your average Chinese data. But it's an indicator, nothing more than that. But it's a telling indicator, and it's a telling indicator from the production side specifically.
What about this figure and its implications for policy, fiscal policy, and also monetary policy? We've had a cut to a multi-decade low in interest rates, and I think that was to do with growth. Do they look at these numbers now and say exactly what you're saying, this is just a once-off, so we'll continue with our ultra-easy policy, historically ultra-easy policy in South Africa?
I don't think this number was fundamentally unexpected. I think recently, once the people had adjusted the latest numbers that were available, the consensus would have been different had it been taken yesterday, kind of thing. I think the MPC certainly takes growth into consideration. I think that this was in anticipation of this kind of number that we had the latest interest rate easing. I think at the moment there's not a lot of scope for that, specifically because of the tremendous pressure which is going to be coming in the next couple of months through higher fuel prices and higher food prices on an inflationary side, which will then kind of balance out the pressures in the economy. So I'm expecting interest rates to remain flat, but certainly this warrants them staying at an accommodative phase for as long as physically possible.
We've got not a perfect storm coming up, Cobus. We've got certainly a few winds. It's going to get a bit squally out there, and it's not just external; it's also internal, isn't it? We've got political, we've got industrial unrest, and all those little sort of pockets of troubles that we have in South Africa. But the external ones as well. People must keep an eye on that. And do you think that'll contribute to also sluggish growth of GDP in 2013?
Certainly. Unfortunately, I think we're probably in for quite a few years of reasonably sluggish growth. I think the gorilla in the room for South Africa at the moment is the impact of the mine violence and whether that will spill over into other mining sectors. Or just see a continuation of the industrial action with the effect that will have on South Africa's economy. But certainly 2013, hopefully stronger than currently, but still sluggish. I think that's the reality for the next couple of years. I think we need to get used to probably a decade of much weaker growth than we would all like to see.
What are the implications for the markets of this sort of number? I mean, and not just directly, somebody says, well, South Africa's only growing at 2.5%, therefore I should maybe shift a bit of the money that I've put into equities over the last couple of years into another asset class or another country. Do you think that is the case? And also, do you think that when the ratings agencies look at these sort of numbers, that's also something that they factor in when assessing our creditworthiness, if you like?
Well, from the rating agency's point of view, I think the biggest concern is if we don't get our GDP growth up, our tax base isn't going to recover quickly enough, which means that our fiscal position becomes challengeable. Up to this point, we've been able to manage that perfectly well, and Treasury's done an exceptionally good job on that. But I think if we miss targets continuously on the growth side, we're going to miss them on the revenue side, obviously. The spending side, the fiscal policy side, is much harder to rein in. So the rating agencies would be concerned about sustained economic weakness.
And if you add to that the political uncertainty, which is undoubtedly going to come to the fore as we go into the conference in December, then there is every chance that there might be some sort of reconsideration of our rating.
I'm certainly expecting that.
Are you?
Yeah, unfortunately.
Implications?
I think from today's release, this isn't unexpected. I think that's important. The credible forecasters have been expecting weak growth this year and slightly stronger, but still weak growth next year. So I don't think we need to. There's no sudden red flags here. I think the implications are specifically around the policy uncertainty side in South Africa. I think that really is. It's not a new story. It's been coming for a number of years almost, where it's much harder to predict where policy will be 2 years out than it was maybe 5 or 10 years ago. And I think that's the bigger challenge in South Africa. And you couple that uncertainty to a significantly weakened fiscal situation, and obviously the rating agencies, if they are prudent, they will adjust accordingly. Are we going to see our investment grade rating being lost? I'm not sure we're quite there yet. I'm certainly hoping so, but certainly the warnings will continue and are being voiced quite strongly at the moment, I think.